Hello and welcome. This is Dr. Tim Liptrap, and we are here in our finance class. We are looking at long-term financial planning and growth. That is the chapter of the material that we're on. We are looking at a simple financial planning model, and what we're looking to do in this particular problem set is solve for the plug variable. And we'll explain plug in just a moment or two. The problem has been set up and given to us in the form of a pro forma income statement and balance sheet. As you can see on my Excel spreadsheet, it is the first two that we have here. I'm going to bring my mouse over and I'm going to highlight this. These two sets were given to us. The income statement of sales was $42,000. The cost of doing business was $32,110, and our net income was $98.90, which is just a subtraction of those two numbers. You can see that that's just a subtraction of the two numbers right there. We were given an asset number 27,000, in which brings just a very simple asset down of 27,000. We were given a debt number of 7,300. Now, this is the tricky part. The equity was given to us, but was also calculated because the assets, this total number right here, has to equal this total number. The assets and liabilities and the equity have to equal. So basically, if we know this number, 27,000, you have to just do a quick a quick addition, and you will get to this number right here. 7,300 plus the 19,000 is 27,000. Okay, so let's set up the problem. It says ABC Company has a predicted sales growth of 21%. It's predicted that every item on the balance sheet will increase by 21% as well. We need to create a pro forma statement and then reconcile them in what is the plug variable here. So we've created the pro forma statement from last year. Now we're going to do a 21% increase. So basically what I did is I just copied and pasted these in, and then what I did was I just put some formulas in. So I took this number, I took the sales number, and I said D9, which is the old sales number, times 1.21. And then I went down here to cost, and I said D10, which is the cost number, times 1.21. And then my net income is just the subtraction. So if you were to look at it, it's subtracting one from the other. I'd like to just show you something while we're here. It is 21%. You would just have this tendency just to multiply it by 21%. But that's not what we're looking for. So you can see where I did this, and here's my equation. I said D9 times 0.21. That gives us, yes, the amount of money we're going to earn, or we're going to increase from one year to the next, but that does not give us the real number that we need to work with. We are actually going to increase our sales by 21%. So it has to include the number from last year, because it's last year's number plus 21%. So that's why we multiply it by 1.21. So this number over here under assets is the same concept. We just did 1.21. We carried this number down right there. Same thing with the debt. Now the equity number was not given to us right here. This number was not given to us, and neither was this total. But here's what we know. We know that the total assets was 32,670. So the total liabilities and equity have to equal, because those two numbers have to equal. So to get the new equity number, this is the trick here, folks. Please make sure you're following this. This is what we do. This is our little trick that we do in this to see if you're paying attention. Is we take our total asset number and we subtract out the debt, which would then be 23,837. That's how we get it. So let me just do that one more time. Our equation is the total asset, because that's a given, in the debt number, which is now a calculated 1.21. It's just we know those two numbers. But on a test or equation, we're not going to give you the equity or the totals. So we just do the quick subtraction, and that gives us our equity. And then once again, we just add them, and they should equal the total liabilities and total assets. Okay. So now here's what we know from one year to the next. We know that our new net income is 11,967. But the equity only increased by 4,137 to 4,137. That is these two lines. So the new number is this right here, we take the new number and we subtract it from the old number, and that's our increase. Now that's important for us to know because that's going to help us with our plug numbers. So then, in order for the balance sheet, equity must be the total liabilities minus total liabilities and equity minus the debt. So the 32,670, which is this number right here, the total number right here, minus the 883, that will give us what our new equity number is. So our new equity number is 23,837. So you could see what I did here. It's the same. I put a little function in there. Now equity is increased by 4137, or the 23,837 minus the year previous, which we just talked about that. That's a 4137 number. Okay. Now the net income is now figured into our dividend, and our dividend is part of the plug. So just bear with me as I do this. The dividend money is 11967, or our net income, minus the increase. Do you see what happened there? Minus the increase, which gives us 7830. If you want to see what that looks like, I just subtracted it. 11,967 minus the 4137 number gives us $7,830. So let me read this again. Net income is 11,967, but equity only increased by 4137. Therefore, a dividend of $7,830 must have been paid. Dividends paid is the plug variable. The dividends paid is the plug variable, and that's what we're looking for.